everybody. My name is Amin Reina. I'm an investment coach here at Sage Investors, and welcome to another episode of Stock Talk here on Periscope. This is episode 45, and today I'm going to weigh in on a debate that seems to be festering quite a bit in the investment community. And it was basically fueled by an article that was posted, or a research report posted by the brokerage company Sanford Bernstein. And the research report, the research note, was called "The Silent Road to Serfdom: Why Passive Investing is Worse Than Marxism." And it's basically a big debate out there between people who believe in actively managed portfolios and passively managed portfolios. So for those people who are like new to investing and trying to figure out all this stuff, what the heck is active and passive investment? What does that mean? So before I get into the article and kind of what basically I want to weigh in on it, just give you a quick Coles Notes version of what active management and passive management is. So actively management portfolios is kind of investing like we traditionally think about it is. It's about picking and choosing investments, products to invest in, stocks, bonds, mutual funds, ETFs, and identifying products out there and stocks or bonds and companies that we think are going to increase in value. And the ultimate goal is to maximize our returns, maximize our capital gains, but also to give it a more, industry kind of lingo, it's to outperform the market, outperform the broader market, to generate what you might hear alpha. So companies traditionally like mutual funds, brokerage companies that buy and sell and trade stocks and manage portfolios on behalf of it, we would have traditionally adopted an actively managed strategy, or actively managed ideology. Now, a passively managed portfolio is one where you're not really trying to pick stocks. You basically, instead of picking individual stocks and bonds and building a portfolio, you basically say, well, I want to match the returns of a broader market index. So, for example, if I wanted to mimic the returns of the S&P 500, I could buy an ETF or an index fund that invests in all the companies in the S&P 500. So essentially, I'm not outperforming the market, but I'm earning whatever the market rate returns. And so there's a lot of research that's gone out there that have said that passively managed portfolios over long periods of time will outperform an actively managed portfolio. So there's a huge debate, and it's really shown now with the proliferation of ETFs, which traditionally have adopted a much more passive passively managed investment style. And the proof is in the fund flows. We've seen huge swings of money away from actively managed portfolios, which tend to charge higher fees and so can eat away at returns, into passively managed portfolios that tend to be low cost and, as I said, tend to be a little bit more from a performance perspective, seem to outperform actively managed portfolios. So it's created this tension now between people who the old school active management portfolio people and the passive, up-and-coming passively managed crowd. And it's kind of fueled this article by Bernstein, which is a traditional brokerage house, so they believe in actively managed portfolios, kind of create a bit of a firestorm out there in the investment community. And a lot of people have basically taken sides and weighed in on it. So the premise is that this whole concept of passively managing stocks or portfolio is tantamount to almost is a very Marxist socialist kind of concept, because by investing in everything in a broad stock market, you're kind of creating a situation where you have portfolios that are very highly correlated, and when they're highly correlated, it makes it less efficient. There's less efficiency with respect to allocating capital to areas and companies and products and services that really deserve to have them. And so the whole concept is by diluting everything and investing in everything in the stock market, you're investing in it gives companies that don't perform very well, don't have great management, don't know how to manage capital. You're basically giving them kind of like a lifeline and kind of turning them into sort of like zombie companies, and who will still be around but will continuously underperform. And they think that by adopting a passively managed portfolio, you're just kind of propping up a lot of these inefficient, not well-run and well-managed companies. And in the long term, from a capitalist perspective, it's not good for our society from a long-term perspective. So they just clapped it with this whole Marxist debate, and that's where kind of people got freaked out. Now, it's interesting because this is all going on recently, but like almost a couple years ago, I wrote an article on my website, sageinvestors.ca, And I was kind of trying to figure this out because I was seeing like this proliferation of ETFs taking over and this whole passively managed portfolio ideology kind of really getting out there and permeating itself in the market. And I was wondering, okay, what would the world look like if we stopped investing in individual stocks and just invested in baskets of indexes? What would that world look like? So I tried to figure it out, and I basically tried the best, I like to figure it out, put things to an analogy. So the best thing example I can give you when I look at ETFs and index funds is kind of like sports cards. So traditionally, when we buy sports cards, if you collected sports cards when you were a kid, when I was a kid, you would collect cards of your favorite players. And like, for example, you collect, for baseball, for example, you're collecting baseball cards. You would collect, the best players out there, like your Derek Jeters, your Mike Trouts, Clayton Kershaw's, Mariano Rivera's, because they're the best players, and you could trade them and trade them for other cool players. And that's traditionally how we thought of sports cards. So you can buy sports cards individually, individual packs, or individual players, or you can buy a complete set, which would mean you would get all the players that played in Major League Baseball for that particular year. So with the good. So unfortunately, what the difference is, you get all the really good players, but unfortunately, you have to take all the scrubs, and from that perspective, it's not a great thing. So to me, investing in ETFs, investing period, there's two formats. You can buy a whole set, buy a basket of companies, which would be buying an index fund or an ETF, or you can buy individual stocks and buy the best players you think, or more specifically, the players you think are going to be really good in the future. So you would buy rookie cards for, in hockey, you'd buy Connor McDavid, or in baseball, like Aaron Sanchez, Noah Syndergaard, or something like that, because they're really young and up-and-coming players, and you think those cards are going to be worth a lot more in the future. So investing is almost similar to that kind of motif in terms of sports cards. So I thought about that. That's how I think about these. That's how I think about these products. So then I think about, okay, how do you price these things? Ultimately, what a market does and a stock market does, it is a mechanism for us for price discovery, to really put a value on what individual stocks are worth. And the price of a stock is usually based on what people think the company's future is going to be, their future cash flows and the future prospects. And the stock market is essentially that price discovery format. And that's how individual companies in the Dow Jones or the S&P 500 get priced. But if we went into a world where everybody buys every company on the S&P 500, then how does price discovery work? Does the prices of those individual stocks then really reflect the value of that company? And ultimately, if you're getting into a situation where you're going to buy a company or merge with another company and you try to figure out what a company's worth, if everybody's just investing in baskets and indexes, then it's really hard to figure out what anything is worth. So you can create potentially a lot of price distortions in asset prices if you adopted a purely, index-only, passively. If everybody went adopted passively managed investment strategies, and so price discovery is a thing. And the second thing is then you're starting to make decisions are now asset values are not being driven now by micro individual company decisions, and because every company is different, they're an organism, they have people and ideas and processes that don't all work effectively, they don't all go in the same direction, they all have quirks and warts and good things and bad things. Some generate amazing products and create amazing wealth, and some don't. And when you take the evaluation of these companies to a macro level, which is what you do with passive investing, you're not interested in the minutiae anymore, it can create distortions in terms of how you perceive companies to doing and how you perceive the overall markets doing, and it can lead to potentially making more ineffective investment decisions. So that's kind of how, so that was my next level of thinking with respect to this whole thing. And then the next thing I thought about was, how do you price risk? So if you bought an S&P 500 ETF or an index fund, which means you're buying one stock of every one of those companies in the index, how do you price risk? Like, how do you evaluate risk of the index? You can evaluate from the index, but an index consists of a bunch of stocks. It's a bunch of stories. And how do you evaluate that? Is there going to be distortions in how we price risk and factor risk into portfolios? And that could have, I was thinking, okay, that could have a pretty distorted impact in the long term in terms of how stock price is making and ultimately how our investments are going to do. So it's interesting. I wrote that a couple years ago, and I was just coming through this mind map, and it came up with this thing. And it's just interesting to read this article by Bernstein talking about almost a similar thing, where it's actually investing. If we adopt a very passively managed ideology exclusively, then are we heading into a world where we're entering some kind of socialist kind of realm of investing, where everybody is equal and everybody is equal regardless of whether how effectively or ineffectively a company is managing their capital, and ultimately that's going to blow up somewhere. So if you ask me where I stand on this, I kind of skew. I'm about capitalism. I make my investment ideologies invest in well-run, well-managed companies that invest, that know how to invest their scarce capital, because capital is scarce. It's not endless, and you have a limited amount of it. And companies that can manage it effectively and use it to create products and services that can generate tangible wealth, can generate returns on capital that are greater than the cost of capital, are going to be purely wealth-creating companies and are going to be much more valuable companies to own. And ultimately, that's my ideologies. I invest in those type of businesses. Now, having said that, do I disagree with passive investing? I think I think there's room. I think a passively invested prefer. The research is out there showing the effectiveness of it, so I wouldn't discount it. So I kind of think what's come out of this article, and what I read a lot of commentary about from people, is really you're either one side or the other. And what I really wanted to share with you today is that I think there's benefits as an investor. It's very important that you have different perspectives and you factor different perspectives as you build your investment ideology, because there's benefits to both of them and other different kinds of ideologies out there. And it's really important. There's a place for it. So I personally, I buy individual companies, individual stocks. That makes a good chunk of my investment decisions. But I also invest in ETFs. I buy baskets of companies and baskets of indexes out there too, because I believe that's there's a mechanism for that, and there's a value in that too. So the answer, like anything we do in our lives, is about moderation. You know, you can't go hardcore active management, and you can't go hardcore passive management. The answer is always something in the middle, a little bit of everything. And I find when you do that, you get to the results you need to get to. So that's what I want to share with you, my take on this. It's just an interesting debate to see how the camps are so hardened and, resistant to anything out there. And that's a key takeaway for me, is that you need to be, as an investor, open to different perspectives and ideas and concepts, because there's nuggets of wisdom and there's nuggets of investing opportunities in all kinds of ideologies out there. So you need to it's important that you consider those factors as you're building your own personal investment ideology. So that's all I have here for today for you. If you have any questions about this or any other previous episodes of Stock Talk, or if you have a question for me you want me to answer in a future episode of Stock Talk, feel free to give me a shout. You can direct message me on Twitter. My handle is @SageInvestors. I'm on there all the time tweeting about all observations I'm seeing in the market and my own personal investment decisions. You can hit me through my website, www.sageinvestors.ca. Hit me through with an email there, and I'm happy to answer any questions that you might have. So that's another episode of Stock Talk. My name is Amin Reina of Sage Investors. Thank you, and we'll catch you again another time. Cheers.